Good morning. Welcome back to the Retirement Report. I'm Hank Parrot, your host. We've been talking annuities this morning, of course, the markets in general, so all the volatility we're seeing, how negative they are for, just for the first not even 5 months into the year. And we're seeing returns, negative returns of 18 to 28%, depending on the index. This is, again, leads into how do I keep taking money out of my portfolio? Because what's happening is stocks are going down, right? See, when we're saving for retirement, and you're putting money into your 401k, let's say, and those stock prices are going up, you keep contributing to it, you're benefiting there. And what happens if they go down? Well, you're not taking the money out, right? So you just keep feeding money in as the stock prices are dropping. You're getting cheaper shares, which means the same amount of money buys you more shares. And then when the market turns up, and it always does, what will happen? Okay, I've got more shares. So when it bumps back up, I'm going to get a boost, right, in my returns. It's going to benefit me to have kept putting money in when the market's going down. Now, in retirement, we have a different issue, right? Now, when the market's going down, we're not putting money in and buying cheaper shares. In fact, unfortunately, it's the other way around. We're taking money out, which means what happens? If I have a certain amount of income I need to maintain my lifestyle, right, and the market's going down, I'm having to sell more and more of my shares just to get the same amount of money out. Okay, similar situation. So this is called sequence of returns risk, and it puts me, and when we talk about risk, meaning it can potentially lead you to run out of money much sooner than otherwise. And in fact, I've shared with you Tony Robbins' piece on that, where he showed someone running out of money within, I think, from the time they retired by age 80, so over, I think it was 15, 17-year period. That compared to, planning for that. Now, you could reduce as we were talking about earlier with Morningstar, you could reduce the spending. You can quit spending as much. You can reduce the withdrawal rate. You don't, which kind of goes hand in hand with that. And by doing that, you can, help stop the bleeding, so to speak. The problem is you still, who wants to do that? Who wants to have their lifestyle affected? So we use tools like fixed index annuities. You can do it on a portfolio. You could just go more conservative on the income side and more aggressive on the growth side. So that means more equities in one portfolio and less in another that's going to be used for income. You can ratchet these things up. If you think in terms of how much time you need to run out a bear market, as an example. So depending on how you're allocated, that could be over the last few bear markets we've had, typically somewhere between 3 and 7 years. So I would need to have a steady income that's going to maintain my lifestyle for that shorter period of time, and then where I can ride out that volatility and not have to sell my shares at a discount. So this is where the planning comes in again. We want to make sure you're able to attain and maintain your standard living quality of life no matter how long you live, and sharing these different options for you. Next week I'm going to get into some of the features and benefits, different riders, different ways that you can use these products to get to accomplish your goals. So one of the things when it comes to planning, all right, is we look at all the different tools available. Okay, and then based on what your specific situation is as to how we match those up. So if you'd like to find out more about it, you can call my office. That number is 615-376-5325. Maybe you'd like to get a comprehensive financial plan at no cost. I will invest my time in you. It's going to take some time on energy on your part as well. We're going to meet probably 2 to 3 times to get it done if you want the whole, comprehensive plan part. We'll talk about Social Security, about Medicare, about how to reduce health care costs in retirement, how to stay ahead of inflation and taxes, how to minimize taxes both on your Social Security benefits as well as on your retirement accounts when you start taking money out. So this is, again, available to you. Just call the office, 615. We're going to, by the way, let me do this. 615-376-5325. That's the number. Call the office. We'll get you information, send you out a packet of things to bring to your appointment with me. When you come in to see me, I'll give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. So what that does in the book, it goes through all the things that we cover in the planning process, including, we haven't talked about, but long-term care needs as well as estate planning. And I've got good resources I can work with your accountant, or if you have an estate planning attorney, or I can help match you up with one to help, again, with this planning process. I believe in a team approach. I mean, it's about working with your attorney, working with your accountant to put together the best plan. So we don't have, if we have a Roth conversion strategy that's going on, we don't want the the accountant to maybe do something or recommend something that would not benefit you as far as, or that would take away from that Roth conversion. There are other situations, maybe in certain years you might have higher income and other years lower income, and we want to balance that out with this planning as well. So that's only, ways to get a tax-efficient income in retirement, to invest in a tax-efficient manner, to maintain your standard living quality of life no matter how long you live, and we do that with using all the different tools at our disposal. So again, if you'd like to get the plan, it's 615-376-5325, and I'll look forward to seeing you. All right, now, when it comes to annuities, again, they're not for everybody. So when we talk about, we need to look at some of the downsides of annuities as well. And this is one of those areas, as I've mentioned before, there are you can categorize, and we got into it last week. We talked, remember, about immediate annuities. We talked about fixed annuities, about variable annuities, and about fixed index annuities, and the pros and cons of each one. Again, if you'd like more information, contact my office. We can get you out a brochure on that. One of the things that comes with the annuities in terms of the different ones is we talked about immediate annuities, where you're just, within a year you want income, so you're cashing in. And they have riders as well, where you can get inflation protection or return of premium or a number of others. Fixed annuities like CDs, right? You get a fixed amount of interest, fixed period of time, and at the end of that time you decide if you want to do something different, or if you like the renewal rate, maybe you continue it. These are sometimes used for short-term needs, where we need the money, we want to make something on it over the next, say, 2, 3, up to 5 years maybe, but we want to play it really safe. So a short-term fixed index annuity, 2 to 3% a year, can be helpful there. Then we want to think long-term. How can I boost up my earnings? And that's where the fixed index comes in, without any risk. I don't want to risk. I want to protect my principal. I want to make sure maybe I can even get some smaller income, smaller interest rate guarantee. There are some that do that as well. I want maybe some nursing home protection, or long-term care needs in general, assisted living, home health care. I want something that's going to maybe help me cover those costs, and there are options for that. So there are a lot of different moving parts when it comes to the annuity. So we want to make sure that, again, we're looking at your specific, and this is where comprehensive planning, we get our hands around what you have for income, expenses, liability, assets. And we look at, on the income side, or do you have COLAs, or is it just a flat income? On the expense side, we factor in for inflation, in particular today, right, when inflation's running at 8%, and that's not counting energy and food. If you factor that in, of course, it's even higher, the things we actually spend money on. So when we're looking at the effect of inflation and taxes, how can we make sure that we can minimize those? And these are all tools that we want to use for that purpose, and the annuities being one of those that can help us get a stable income going up over time, while whatever's going on in the market, it's not going to impact that. So that's one of the advantages I've talked about. Again, disadvantages such as surrender penalties. The indexes themselves, again, it depends on the product, but if you're looking at uncapped, there's no guarantee of return as there are with fixed, but they have historically outperformed the fixed annuities, and outperformed, as I mentioned in Roger Ibbotson's article, also outperform bonds. So it can be a very good mix for you, and then putting all the different pieces so that we get the right product for your specific situation, that's the other part. Some people are really concerned about the surrender penalty thing. They don't, well, I'm tying up my money, and this is true. It's a long-term investment. So this is one of the downsides with this particular long-term investment is when you invest in it, it does, you're locking in for a particular contract period. Now, these contract periods can vary. You can have 6 years or 10 years or, 6, 8, 10, 12 years. I've seen some out there at 15 years. And it depends. If you can lock in a fixed rate for a longer period, at least when rates go up some more, that could be a benefit. But with fixed index, that is one of the downsides. You got to make sure it's a product you're going to be wanting to keep in your portfolio for whatever specified term you elect to do. And there are other trade-offs with regard to returns. So again, lots there to digest, more than probably what this show is going to help you with. But again, I'm willing to help you with some more, and I can get you some brochures as well. First, we're going to take a break, and then I'll get that up for you again. The number is, not the number. Join us here. We'll be right back on the Retirement Report.
When could paying more tax mean paying less tax? Here is money tip number 54.